Have you ever wondered if the cash in your wallet is becoming a relic of the past? The way we think about money is changing, and it's happening faster than ever. We're in the middle of a massive financial revolution, moving away from physical cash and towards a fully digital world. At the heart of this transformation are two game-changing innovations: cryptocurrencies and central bank digital currencies, or CBDC. Today, we're going to dive deep into the world of digital money, explore how it's evolving, the challenges it brings, and how governments around the globe are racing to control it. So, what exactly is digital currency? Simply put, it's any form of money that exists only in digital or electronic form. The first type you've probably heard of is cryptocurrency. Think of Bitcoin, Ethereum, or even Dogecoin. These are decentralized, meaning no more single company or government controls them. They run on a technology called blockchain, which is like a public, unchangeable digital ledger. Then you have stable coins, like Tether and USDC. These are a special type of crypto designed to be less volatile because their value is pegged to a real-world asset, usually a major currency like the US dollar. Finally, we have central bank digital currencies. These are the big ones to watch. Imagine a digital version of the US dollar, the euro, or the yuan, issued and controlled directly by a country's central bank. China is already testing its digital yuan, and many other nations are exploring their own versions. But why did all of this suddenly emerge? Three key factors fueled this financial fire. First, technology. The invention of blockchain was a breakthrough. It created a way to have secure, transparent, and decentralized financial systems without needing a traditional bank in the middle. Second, globalization. As our world became more connected, we needed faster and cheaper ways to send money across borders. Traditional international transfers can be slow and expensive. Digital currencies promise to make it instant and nearly free. And third, financial inclusion. Billions of people around the world don't have access to a bank account, but many of them have a smartphone. Digital currencies offer them a direct path to join the global economy, to save, send, and receive money without a bank. Of course, like any new technology, digital currencies have their pros and cons. On the plus side, transactions can be incredibly fast, sometimes settling in seconds instead of days. The costs are often much lower. You can send money anywhere in the world with ease, and the underlying blockchain technology is highly secure. For cryptocurrencies, decentralization is a huge draw. It means no more single entity can freeze your account or block your payment. But the downsides are significant. The price of many cryptocurrencies is notoriously volatile, swinging wildly in value. The space is also filled with scams and fraud, and there's very little consumer protection if you get hacked or fall for a trick. The anonymity that many people laugh about crypto is also a double-edged sword, as it can be used for illegal activities. Naturally, this has made governments very nervous. So why are governments so keen on creating regulations? It all comes down to control. Cryptocurrencies operate completely outside of the traditional financial system, which challenges the power of governments to manage their economies. They worry about losing control over their money supply. If everyone starts using a currency they don't issue, how can they implement monetary policy to fight inflation or recession? Another huge issue is taxation. When people hold assets in anonymous crypto wallets, it becomes much harder for governments to track wealth and collect taxes. And of course, there's the prevention of financial crime. The untraceable nature of some crypto transactions makes them attractive for money laundering and the other illicit trade. Finally, governments feel a duty to protect consumers. We've all heard stories of people losing their life savings to crypto scams, exchange collapses, or market crashes. Regulations are seen as a way to bring some order and safety to this Wild West. Because of these concerns, countries are taking very different approaches. The United States has a fragmented system, where different government agencies like the SEC and the CFTC regulate different aspects. Crypto exchanges have to follow anti-money laundering laws, and the crypto is taxed as property. Meanwhile, the European Union has rolled out MiCA markets in crypto assets regulation. This is the world's first comprehensive rulebook for crypto, designed to protect consumers, stabilize the market, and put strict controls on stablecoins. Then you have China, which has taken one of the strictest stances anywhere. All cryptocurrency transactions are banned, and the mining is prohibited. At the same time, China is a world leader in developing its own CBDC, the digital yuan, giving the government more control, not less. In contrast, places like the UAE in the Middle East are positioning themselves as global crypto hubs with friendly regulations to attract talent and investment. This brings us to the rise of central bank digital currencies, or CBDC. This is arguably the most significant shift in modern finance. Governments aren't just reacting to crypto, they're creating their own version. Why? Because CBDC offer the benefits of digital transactions like speed and low cost while keeping the central bank firmly in control. A CBDC could reduce the cost of printing and distributing physical cash, improve financial inclusion, and give governments a powerful tool to counter the rise of private cryptocurrencies. Most importantly, every transaction would be traceable. The benefits are clear: real-time payments, better monetary policy tools, and the enhanced security. But the risks are just as profound. A fully traceable currency raises serious concerns about privacy and the potential for government surveillance. What happens when the government can see every single purchase you make? There are also major cybersecurity risks and the questions about how CBDC would impact the traditional banking system. Looking ahead, the future of digital currency regulation is starting to take shape. We'll likely see more global standards emerge, with countries agreeing on rules for things like taxation and the transaction reporting. Crypto exchanges will face much stricter licensing requirements, demanding strong compliance and the identity verification. Stablecoins, in particular, will be under a microscope. Governments will demand that they are fully backed by real reserves and they operate under strict financial laws to prevent a collapse. All of this is geared toward one thing: consumer protection. Expect to see more anti-fraud systems and better dispute resolution mechanisms. This new world of digital money is also forcing traditional banks to evolve. They are no more longer the only game in town. Digital currencies compete directly with core banking services like payments and savings. To stay relevant, banks will have to innovate. We're already seeing them explore blockchain for faster settlements, adopt digital identity systems, and use smart contracts to automate processes. It's a classic case of adapt or be left behind. The economic impacts will be huge. Digital payments can boost GDP growth by making business more efficient. Financial inclusion can lift people out of poverty. Lower transaction costs benefit everyone, from big corporations to small shop owners. But this also means a massive increase in government oversight, for better or for worse. So what does the future of money look like? It's not going to be our of just crypto, or just CBDC, or just traditional banks. We're heading toward a hybrid model where all three coexist and compete. The Wild West days of unregulated crypto are numbered. No more government will allow a parallel, anonymous financial system to operate unchecked for long. Slowly but surely, cash will continue its decline, and the money will become fully digital. To wrap it all up, digital currencies have completely redefined our concept of money. They present incredible opportunities for innovation and a more connected global economy, but they also bring serious risks. The journey ahead is all about finding the right balance between encouraging this innovation and maintaining control to protect consumers and the stability of our financial system. The question is no more longer if digital money will become dominant, but rather how it will be regulated, monitored, and woven into the fabric of our daily lives. Thanks for watching. If you found this breakdown helpful, don't forget to like, subscribe, and hit that notification bell for more insights into the future of technology and finance. See you in the next one.